let's kick on with The Age, where the headline tomorrow reads, Big banks tip up to 5 rapid rate rises. The nation's 4 biggest lenders say interest rates will rise at least 4 times in the 6 months after the May federal election, adding hundreds of dollars to the mortgage repayments of home buyers amid concerns within the Reserve Bank that inflation pressures are growing. The development puts the more pressure on Prime Minister Scott Morrison and Opposition Leader Anthony Albanese to convince voters they can manage the economy and cost of living pressures at the upcoming poll. Caro, I found it really interesting today, Clive Palmer's address at the National Press Club, where he spoke about research that they have done into mortgage stress, which is a very real issue and has been a very real issue for a lot of Australians for a number of years now. But given the fact that interest rates are set to skyrocket compared to what we've seen over the last couple of years, this is going to be a very, very big issue in the lead up to the election. I think that Palmer, for all of his flaws, was on an interesting wicket there today.
I did think that was an interesting point. The thing that I'm still not sure about is, well, what if the bank's lending costs, go above that point? What if that happens? Then who pays? Who pays, for that delta in lending costs? So I think I appreciate the point. Whether it's actually practical and able to be implemented without causing more damage, I'm not really sure. But, Jenna, we were talking about rate rises in October last year.
Yeah.
And we were talking about how the market had already priced them in to the second half of this year. And this is when the RBA was still like, no, we're not doing anything till 2024. Then all of a sudden, inflation in the US gets out of control. Inflation in Europe is even worse than it is in the US. And then all you need is one geopolitical dispute, a war and some sanctions, and then all of a sudden, food prices and all sorts of things start going through the roof, which then, pours fuel on the fire. And all of a sudden the RBA's language has really, really changed. And as I've said before, Jenna, and I will say it again, even though I feel like it's ad nauseum, inflation isn't a problem until it's a problem.
Yeah.
And when you don't deal with it until it's a problem, then you've got to hit it harder. If we had have managed this, I think probably, a little bit earlier, you could have had a couple of more subtle rate rises without essentially having to get the sledgehammer out to try and stop inflation. I don't necessarily think it had to be this way, and I'm not quite sure why it's kind of been left this late. But ultimately, people who have mortgages will be the ones who suffer the most. Yeah. There is a rule, APRA has a rule that there essentially has to be, a 3% buffer when lending is done, so that there is that room for mortgage holders to essentially to be able to cope with an increase in interest rates.
Yeah.
And I suppose when the tide goes out, we will see who's starkers and who's not, and who's done their credit properly and their due diligence and all those other things. The other thing, sorry, Jenna, one last point. The most important factor here is actually not necessarily just interest rates. It's employment.
Yeah.
Because even if interest rates go up, as long as people have jobs and they're able to service their debt, the impact is not going to be as significant as if we start to see a rise in unemployment at some point. Because as soon as you have a rise in unemployment, you lose total serviceability of debt, and that there is really there's a car crash that we want to avoid.
That is nightmare-inducing stuff, Caro. That's not good at all to hear.